Hey folks, welcome to Narratives. Narratives is a podcast exploring the ways in which the world is better than in the past, the ways it is worse, and the paths towards a better, more definite vision of the future. I'm your host, Will Jarvis, and I want to thank you for taking the time out of your day to listen to this episode. I hope you enjoy it. You can find show notes, transcripts, and videos at narrativespodcast.com. Well, Paul, how are you doing today?
I'm good. Thank you for the invite to the podcast, Will.
Absolutely, sir. Thank you so much for taking time out of your day to come on. I really quite appreciate it. Do you mind giving us a brief bio and some of the big ideas you're interested in?
Sure. In terms of bio, I'm originally from Germany. I did high school there and graduated just when the global financial crisis broke out. I originally wanted to be a lawyer and study law, but in the final and then do finance in the political sphere eventually. But in my final 2 years of high school, the global financial crisis broke out. I was interning in the finance committee of the German Bundestag at the time.
Oh, wow.
When institutions like hyper real estate fell off a cliff and started taking other big institutions with it. And people slowly realized that we might be facing a big event here, a generational event. And politicians, policymakers, people from the ECB, other institutions, they rushed to find some sort of blueprint what to do in a major global tail event like the financial crisis. And it turned out there is nothing like a blueprint because we assumed that there would be no more financial crisis in the world, that markets are efficient and risk can basically be allocated away between market participants. And around the same time, Ken and Carmen Reinhardt's book on 8 centuries of financial folly came out. And to me, it was a revelatory moment in many ways, because I thought this is the way to study finance and economics and policy making through the historical lens and through the realization that there's more than just model building or physical equations to economics. We are dealing with chaotic systems, with humans in the end who are emotional, and history is the best laboratory to study these chaotic processes over time. And so I really became strongly convinced that I wanted to do economic history, financial history, with a strong applied angle to very much focus on the market side, on the trading, but also on the policy making side, eventually to provide better answers for the practical world, in other words. And I decided to go on a longer academic journey and do financial history and economic history. And I started that at LSE and then continued it at Harvard. And now I'm here at Yale writing a book for Yale University Press on my dissertation and on long run trends and interest rates. And that's the short version of it, I guess.
I love that. And, Paul, I really like your approach, because it seems like, a lot of, opinion analysts and even scholars, when they talk about, the great stagnation, secular stagnation, they all look at this like super small sample size, right? It's like, well, the last like 50 years, what happened since 1971? But what I liked about your approach, what I found fresh, was like, okay, let's take a much bigger sample size. What have the last 800 years been like, and what does the trend look like? And let's try and figure out what's going on there. I'm curious, can you talk a little bit about what you've found looking at interest rates over the last 800 years?
Yeah, absolutely. So during my PhD studies, I was seconded to the Bank of England for a couple of years, and it was a great experience because it was again a very applied / policy oriented environment. And of course, the big question then, as well as now, was from a policymaking perspective, what are we doing about the key measure in the global financial system, namely the interest rate? And why is it behaving in such weird ways? Why is it behaving contrary to everything that we find in textbooks and in financial literature and models? Because, all the reference literature tells us something very different to what we have seen, not just since the financial crisis, but for a longer time. So there was a big puzzle here. It puzzled market people as well, people in investment banks and in hedge funds, etc., and people who invest in pension funds, who invest for the long term, for instance. So it has a massive, not just a policy, but massive market relevance. That question now. I'm not so original as a financial historian per se for wanting to take a longer look than the mainstream econ literature. So my advisor at LSE, Steve Broadberry, he constructed GDP series starting in the 13th century for England, for instance. And I got exposed to these approaches in my undergraduate years. The thing is, nothing like this exists for the capital market side. So we have an increasingly good understanding for some of the macro variables, including output growth, including living standards, i.e. per capita GDP. Angus Madison, these people have done tremendous advances over the years, but not so much in capital markets. In fact, our reference work for interest rates is 6 decades old.
Oh, wow.
It's Homer and Silla's History of Interest Rates, which first came out in 1963. We had several updates, and Dick Silla came in at a later stage and did a tremendous job. However, for a lot of purposes, it doesn't really cut it. So our reference literature on the capital market side is, I would say, deeply deficient and unsatisfactory. So that's where I saw a niche, and that's where I saw a great applied relevance and a chance to demonstrate the value of applied history to answer the secular stagnation questions in a much more satisfying way, I would argue, but also have a big relevance to the practical, to market people and policy making. Yeah.
Got it. And can you talk a little bit about what you found? So I want to summarize what I read in the paper. It's something like, over the last 800 years, we've had this long run trend downward of interest rates, intersecting with zero right about now, maybe a little bit before, maybe a little bit after. Is that a correct understanding?
So there are two streams of literature I would say that I try to reply to. So one is a more abstract finance literature that has looked at the statistical properties of interest rates and the general dynamic behavior of interest rates, i.e. is the interest rate a stable variable over time? Gotcha. Is it a random walk? Is it subject to certain regime changes where the mean shifts around? Now that sounds very abstract, but it's of big relevance for asset pricing in a very fundamental way. Because if you say the interest rate is a random walk, but other variables like growth or consumption are clearly not a random walk, then a lot of the asset pricing models have a problem when they assume higher growth means higher interest rates. Okay. So Gotcha. It has a big impact for these stylized facts that people operate with on a daily basis in markets and in finance. So that was one stream of the literature that I wanted to address over the long run. Nobody had ever done more than a couple of decades of data on that front. And the other one is really the econ financial history literature. I mentioned Homer and Scylla, and apply a new comprehensive empirical investigation to secular stagnation, to the zero lower bound literature, all these questions about, okay, the key tenet here is that if you talk about secular trends and secular stagnation, namely, then I think it's deeply problematic to look at 4 or 5 decades of data, okay? Secular stagnation, secular trends in the economy, by definition, per se, they try to make general statements about the economy. They try to uncover the structural, glacial movements in the economy. That's the secular component here. And so I think it's quite pointless to base these kind of theses on 4 or 5 decades of data, because then you're capturing maybe one cycle of these secular glacial movements in the economy and financial markets, okay? But that's not a secular picture that you have. You have one cycle of the secular way the economy behaves. So that called, in my view, for a long run reconstruction of global real interest rates, which I then did on the basis of both published data in existing secondary works, in existing printed primary sources, as the historian calls it, i.e. registries from early treasuries in France, in Germany, in the urban centers where the big merchant banks were based, like the Fuggers in Augsburg. So it turns out, with a bit of patience, you can uncover a lot of material, even without going into archives and really looking at dusty old files and trying to decipher 14th or 15th century Latin. That is the icing on the cake, I would say, which I also try to do to the best extent possible, which is completely lacking in works like Homer and Scylla. They never went into archives and tried to get primary sources. So you asked about the results here. The big result is that global real interest rates have actually fallen for over 5 centuries in a consistent cross-country, cross-asset fashion. And the idea that something happened in the 1970s or 1980s that initiated a trend fall in the global real rate is quite misleading. Because the real interest rate, the global real interest rate, has never been stable prior to the 1970s or 80s. There's no natural level of the global real rate, say somewhere between 3 and 5%. And once we figure out what happened in the 70s and 80s, we can go back to that sort of level. This is an implicit or often explicit assumption that people make in the debates. No. The global real rate has always fallen in a range of 1 to 2 basis points per annum throughout monetary regimes, throughout different political regimes, whether it's a democracy or a monarchy, like the French monarchy over centuries, the Holy Roman Empire. They all saw this trend fall starting at least in the early 16th century. After the famous bullion famine that gripped the entire world, and after the Italian wars, one of the biggest conflicts and long-lasting conflicts in the early modern period started. That has also not just big implications for the whole secular stagnation debate, but also for the first set of literature that I mentioned. It means we can statistically look at this new time series and the new evidence over centuries. We can confirm statistically, okay, it's a monotonic downward trend over time, but it's also not a random walk, okay? The interest rate is not a random walk, which is the consensus view in the finance literature. for some time. In fact, the global real rate is something that these statisticians would call stationary. In other words, it has a predictable component over time. So if you're an investor and if you had access to that time series in the 16th or 17th century, you could have predicted that the global economy and markets would discuss and grapple with the zero lower bound in the early 21st century. You could already have predicted. That's the stationary component, the predictable component that is downward trending over time. So these are 2-3 elephants in the room that I try to take out, or at least question from a long run financial historian's perspective, and that's the motivation behind it.
I love that, and it's I mean, it's a super interesting finding, right? And it's also, it begs the question, why is, like, what is this structural force underneath the economy that's pushing, interest rates down over time in such a consistent manner? And, why is, like, the why question is always overdetermined, but have you thought about it at all? Like, why this is the case?
Yeah, absolutely. Of course, this immediately comes to mind, and there's not one conversation where people squeeze me on that. I try to start answering this question in a negative way, in the sense that I try to go through all the usual suspects that are being invoked at the moment in the context of the secular stagnation debate, in the context of the current finance literature, which basically tries to highlight three factors. One is a potential productivity story. In other words, the whole Robert Gordon argument that we run out of ideas, we are no longer as productive, we are no longer
Picked all the low hanging fruit. It's just much harder now.
Wheel. Exactly. We're no longer making the kind of gray matter leaps that we did in the first wave of industrial revolution, second wave. So that one is easy to rule out because, as I mentioned, actually the output picture over the long run is pretty good. So you can take my new data on interest rates and compare it or set it against Angus Madison's data on GDP and on productivity, right? Or on against Steve Broadberry's series for England, for instance, when you take my English series. It turns out that not just are interest rates and GDP growth not strongly correlated over time, which a lot of asset pricing models assume. No, in fact, they're going in opposite directions over the very long run. So the growth series can be thought of, if you look at the works out there, it's basically a hockey stick trajectory over time, right? So for a long time, it hovers around $300, $400 per capita in real terms in 1990 up until the point where the Industrial Revolution starts and we see a sharp acceleration. However, at the time of the Industrial Revolution, global real rates have already come down substantially by a big amount. I mentioned it starts in the early 16th century. So for about 300 years, global real rates are already consistently falling when the Industrial Revolution takes off. So that's why I first question this whole productivity story that is supposed to lie behind the downward trend since the 1980s. No, I don't think it's a productivity story. I think that even if growth sharply accelerates again, if we make another big ICT, a big general purpose technology invention like the internet, like something else, that doesn't necessarily mean that we get a trend break in global real rates and they start going up again structurally. I don't think so. History tells you that actually there are long sustained periods where they go in completely opposite directions, and that might be that might call for a lot of revisiting of these asset pricing models, and market people would always assume that there should be a positive correlation between these two variables, which might still be true for the short term for business cycle. Okay, if we look at quarter revisions of GDP growth, it's still very much plausible that the real rate should go up. Okay, but I'm talking about the structural, the more glacial trends in the economy. So second explanation, demographic factors. Maybe some of your listeners have seen the new book by Charles Goodhart, and other people have invoked demographics. The idea being that if people live longer, if life expectancies go up, they have to save more for retirement increasingly, okay? And they invest this money typically in fixed income because this is a long-term asset, okay, with predictable returns, okay, less risk than equities or other asset classes. Makes sense from the outset, right? The problem is that we have reasonably good data on life expectancies over time as well. Demographic historians, other people have written books about this. We have good time series. And advanced economy life expectancies hover around 40 years until the 19th century or so. Okay, so guys like us, I guess, have a couple of more years, and then we would be expected to either go into retirement or you know, we pass basically. Okay, so within a century, in the 19th century, advanced economy life expectancies go from 40 to something like 70. Okay, it's the biggest leap in demographic variables ever seen. But again, if you remember what I just said, real interest rates start declining in the 16th century rather than the 19th century. Okay,
way before it.
So, which means the big inflections in life expectancy don't really cut it either, in my view. We should have seen a massive break in global real rates in the 19th century when that happens, when the demographic revolution happens. Not in the data. We don't see that. Okay, so that's why I'm very skeptical about the Charles Goodhart's arguments as well, and the whole demographic channel. It's not really there, which leaves a couple of other factors which I think are more promising. And I should also say from the outset that it's not a sovereign risk story, in the sense that, of course, a lot of your listeners will immediately say, the first thing they will say is that, of course, these kind of issuers, these governments in the 15th or 16th century, of course, they are so much more risky to lend to as an investor. It's natural that I would charge a much higher risk premium, of course, okay, to hedge myself against the risk of, look, we have all these examples where the creditors of the French king, if they are too insistent on repayment, they end up in the French Tower, or they end up in the Bastille, and they wish they hadn't really,
bugged them so much. Yeah,
asked for their money back. Absolutely, of course, the governments per se are safer, okay, in terms of the default risk than they were in the 14th and 15th century. But it's not a default premium story either over the long run, okay, because sovereign risk is relative. We can isolate the safest economy over time, and we see the same downward trend over time in the safe issuers who never threw their creditors in jail, who never resorted to big debasement operations, which is the classical default event in the early modern period. So you simply reduce the gold content of your coins by 50% or so, and then you tell your creditors, well, here you have my new currency. Look, it says the same. It's the same nominal amount. Okay, it's just 50% less gold in these coins. Okay, So that's how governments did it for a long time. They didn't even have to default on the principal. Okay, they repaid the nominal amount in the principal, just with a very different currency. Okay, so we have knowledge of these events. We can trace them. We can reasonably relate these to real interest rates, and we don't see that. So even the countries that never had debasement shocks, debasement defaults, even these countries show the same properties. And secondly, I touched upon it earlier, we see that trend in other assets as well. So not just sovereign assets, we actually see the downward trend in private rates as well. Oh, wow. So I'm showing one series in the paper on private mortgage rates in real terms over time. Yeah, and with good reasons, you can argue private households in the 14th, 15th, 16th century are actually safer to lend to than governments. Okay, you can make that argument. It's a fair point. However, we are seeing the same trend in private real mortgage rates, long maturity mortgage rates, voluntary market rates over very long periods of time. We get 1.5 basis points per annum. Okay, and the asset is highly comparable to a mortgage that you take out nowadays. Okay, a 30-year fixed mortgage or so. Okay, same properties. You have collateral. You need to put up collateral. You need to, it's tradable in the secondary market. It's typically secured by the underlying real estate to some extent. Okay, and your personal income, and it's heritable. Okay, so your descendants still have to pay it if you're on the debtor side. If you're on the creditor side, you still receive the payments if the other party dies or just runs away or so. You have good legal protection, in other words. So, which in my view leaves two very promising factors here. One is a time preference channel that is at work, and one is a more general capital longevity story, which are both important, which I think there might well be more to it than these two explanations. And I very much think there's more to it. There is a bigger factor here that we still, and that I still don't fully understand. Okay, that you can imagine I've read for years now. I try to figure it out. Talk to many people who've spent their lives thinking about long run trends. There's still a big question mark over all this. Okay, maybe something happened in the 16th century. For which all evidence, all the documents, everything has been destroyed. And there's a big mystery that we will never uncover in that sense, okay? We cannot, unfortunately, we cannot go back to the early 16th century and interview contemporaries or so. It's a big challenge in that sense. Something happened in the 16th century which we, in a very fundamental sense, still don't understand, I think. So, but two things are evident. One, you have to remember that capital markets over time are basically a story of top 1%, top 5% people investing and taking money out, etc. dynamics. That's true nowadays. That's true in the 15th century as well. So in other words, the top 10% wealth share in the 15th century is around 50-60%, comparable actually to levels today. Okay, it's not dramatically different, which means that 50-60% of your fixed income assets around there are subject to the dynamics in that particular social and economic group. Okay, and this is what we should focus on. Okay, if there's any big institutional factor that only affects these people but in a big way, then this might be much, much more important for capital markets than one big event that affects everybody. In other words, something like the French Revolution, okay? And that's actually the case, I think. So what happened in the late 15th century was, for instance, that the feud was outlawed.
Oh wow. Right. Yeah, there's a big movie. Ridley Scott just talked about this recently, right? Yeah.
Exactly. So for in 1495, the feud is outlawed in Germany. Okay. What does this mean? In an economic sense, we can see the effect in a dramatic reduction of personal violence. Okay.
Oh,
So
got it.
basically, for 2 centuries, it's perfectly legal and actually expected that if your neighbor insults you in any shape or form, or he doesn't repay some sort of personal loan that you give him, or he I don't know, he insults your daughter or whatever have you, it's perfectly normal and expected that you gather a few friends of yours, you assemble some horses, and you raid his properties. You put his castle on fire, and excuse me, and you destroy his property as comprehensively as possible, and you kill him as well.
Right.
In the end, when the feud is outlawed, we see a sharp drop in top 10%, top 5% violent deaths. Okay.
Oh wow.
So even though society-wide life expectancy doesn't change and population growth doesn't change, for this particular group who is active on financial markets all the time, life becomes so much more secure, stable. Exactly.
Oh, wow.
Exactly. And so what does it mean? It means that if you don't have to fear being stabbed or killed on the street every other day by your neighbor or by someone else, your investment style changes in very different ways, in very fundamental ways. You're much, much more likely to take out a 30-year mortgage or lend money to your king or to your duke for 30 years, because you're much more confident that you live when the contract ends, and you can receive the principal back. Okay, this is what economists have called a time preference before. Okay,
right.
So time preference. How patient are you in the end? Okay, so what it means is that suddenly people are becoming much more patient in financial markets. Yeah. So these inflection points in patience line up very well with what we're seeing on the real interest rate series, and it would I think be a very plausible explanation, at least part of the story, a very plausible part of the story, which we don't get from a lot of these other factors. A lot of these other channels are thrown around for years now in the secular stagnation debate. Patience is increasing, and it starts in the 16th century that people are becoming more patient in financial markets. I can go on for hours basically until you interrupt me, Will.
No, this is great. This is great. I mean, that's such an interesting thing to think about. Is like, humanity, especially it sounds like the elite section of society has gotten more patient over time because their lives have become somewhat more stable, pretty steadily.
Correct. The one big inflection point in recent times, in terms of patience and in top 10%, is World War I, actually. Why? Because a lot of historians, including David Cannadine, for instance, for Britain, who wrote a seminal book on the decline and fall of the British aristocracy, they always point to World War I as the last stand of the old elite, basically in the world. Okay, so in no other conflict since since the Italian wars in the 16th century, basically, did such a great number of top 5%, top 10% investors die suddenly on the battlefield than
Oh, wow.
World War One. And we see it in the violent death series that I mentioned for financial market participants. Basically, one last time, it surges during 1914 to 1918 in ways that nobody would have expected, because a lot of this top 10% people, for one reason or another, for cultural reasons, for reasons of pride and honor, call it what you will, they go to France, they go to the front, and they die in the trenches. Actually, it's a huge number. It's not just the common soldier. If you actually look at the figures, it's the biggest violent death event for the European elite in centuries, World War One.
Wow.
So this is another inflection point, actually, that aligns very, very nicely with the real interest rate series. The big statistical break in the interest rate series over time, over centuries since the Renaissance, are the year 1510 and the year 1912. And these are also, it happens, the two big violent death events in advanced economies for centuries. So I think this channel is one of the most promising that I'm looking at.
Gotcha. And did you have one more other than the patience? People getting more patient over time?
Yeah, the other one is what I call the capital longevity story. In other words, the interest rate is a function of capital demand and supply, obviously. And if your capital stock grows faster than the demand for, or so if the existing supply rises faster than the demand to take out new investment projects, new loans for whatever reason, then obviously we should expect the interest rate to fall. Now, why would this happen in a structural sense, in a long run sense? It happens because of the fact that our capital stock is becoming more advanced, more durable. So Simon Kuznets, the famous US economist, once wrote a fascinating article about the early modern economy. And he quipped basically and said, there's no such thing as permanent durable capital in the early modern economy, except for cathedrals. Everything else, so basically a bridge in the early modern economy, a fixed asset, collapses within 2 years, basically.
Gotcha.
Okay? Given its technological features, etc. Your average house, your average hut, as I mentioned, is burned down by some sort of raider or mercenary, typically within a short period of time, or just collapses in the same fashion because it's made out of mud or primitive stones or whatever. There's a slow but steady process where the capital stock is becoming more and more durable and
Gotcha.
long living. Now contrast that bridge or that hut with things you see today. I mean, for every European who flies into JFK, which is a big fixed infrastructure asset, JFK Airport in New York, it often feels like time travel for a European. You know, it's like going back to the 1960s or 70s, right. The way it looks like.
Yeah.
But what I'm trying to say is that it's a big fixed capital item which can last and live for 60, 70 years without any issues at all, without anybody wondering about this. So capital is becoming more and more durable, which means you do not, I mean, it depreciates, of course, capital depreciates, you have to reinvest, you have to keep your runway in shape in the case of JFK, but it's a different story to having to reinvest and rebuild the entire capital stock time and time again. Okay, and of course the other big factor is simply wars that destroy big portions of the capital stock all the time in the early modern economy. Okay, so say during the 30 Years' War, the 30 Years' War is perhaps the greatest capital destruction event that we've ever seen. And in one of my chapters of the dissertation, I tried to estimate the capital destruction from some of these big wars in the early modern period, and compare it to, say, World War I, World War II, because I was interested if it is a plausible explanation for what's happening on the asset pricing side, right, in capital markets. So during the 30 Years' War, around a quarter of the capital stock in Germany is completely wiped out. Okay. And the 30 Years' War, of course, is only one war event of a very, very frequent, very, very violent early modern period. Now, what we are seeing since 1945, the fact that we did not have a war between advanced economies invading each other for a period of 80 years now almost in advanced economies, it's unprecedented in long-run economic history, in financial markets. Okay,
right.
So the other day I tried I tried hard to find a previous period where we had such a long time where two countries, advanced economies of the day, did not fight each other and destroy each other's. And the most recent period that I could find was the aftermath of the War of Saint Sabas in the year 1256, which was a war involving Genoa and other Italian city-states. After that war, we had another 75-year period where the leading economies did not fight each other. In other words, these past 80 years were remarkable for the fact that we could build up a capital stock that was not subject exactly to destruction, to bombings, to all sorts of capital destruction dynamics, which were perfectly normal and going on all the time historically. Okay, that's what I mean with capital longevity, which is the other. But not to confuse people, these wars that I'm talking about, I talked about the violent death channel, the patients. The 30 Years' War, all these other wars, they are fought not by the top 10%, not by the top 5%, but mainly by people who do not buy and sell assets themselves. Gotcha. Because they don't have savings in the 17th century, just like they are more unlikely to have savings nowadays in big numbers. So these are two, I'm just saying, these are two separate channels. Okay, one the capital destruction channel, and one the patience channel, which is more a function of the actual group of people who invest in markets all the time.
That makes sense. No, I really love that, and it almost echoes, Steven Pinker's "Better Angels of Our Nature." Like if the world's getting less violent over time, maybe we see that reflected in real interest rates over time, which is quite interesting.
And Walter Scheidel has written something about capital destruction events as well, of course, but none of them have tried to make the link to asset markets and really to what we're seeing since the 1980s, of course, and thought about in more comprehensive ways what it means for asset pricing per se in a fundamental way. Yeah. Gotcha.
Very, very, very interesting. I want to shift a little bit for our last couple of minutes and talk about, banking crises. So you said, you were working with the ECB 2008. So you got to see these things kind of firsthand and how everything unfolded. What's your sense? have policymakers gotten better at dealing with banking crises over time? You know, I like to read Scott Sumner. Scott's got this idea that, you know, we could have prevented the 2008 financial crisis, but we didn't. You know, the Federal Reserve didn't for whatever reason. You know, could have been bureaucratic reasons. Not clear exactly why. Yeah, what's your thought on that? Have we gotten better over time at dealing with these?
Um, well, that's a great question, which allows me to advertise my latest project here at Yale with Andrew Metric. What we did over the last 2 years was build a new database um, which covers banking crisis interventions since the year 1257, up until 2019. The idea being we wanted to catalog and analyze every single intervention that public authorities or other private market participants made in the banking sector to relieve some sort of stress event, to address some sort of malfunction in the banking sector over time, based on 20 different intervention categories, and then study the longer run trends in responses to bank stress, banking crisis, okay? With the exact intention, can we learn something about how the secular response to these stress events changes? Are we getting any better, or are we getting worse? Or do we have to do more and more and more intervening in the financial sector because it's malfunctioning in ever greater ways? Yeah. And so that database is publicly accessible, and everybody can study it. But our takeaway, for one, is that interventions are in fact becoming more and more and more frequent. Okay, and they have to become larger and larger in size as a share of GDP, certainly. So we have to spend more and more and more money to address problems in the banking sector, to try and alleviate stress and prevent systemic events from happening, basically. Now, that simple fact suggests that, the counterfactual is, would it be even worse had we done nothing in over the last decades or so? But one way or another, at least it's not falling. That
Right.
measure. It's a disturbing finding, I would say. It does not suggest that the problem is fading, that we are getting better at. No, we might be getting better in a relative sense compared to doing nothing, but we still have to spend more and more and more money trying to fix the banking sector, and that's not a good thing, certainly for society. That means that the problems are continue to accumulate in the banking sector, in the financial sector, and that we have to spend more and more resources trying to fix whatever is going wrong there. So in that sense, no, we have not gotten better in that sense. So we show the exact numbers here. So we are saying basically that the average intervention size in the economy goes from something like 2% of GDP in a typical intervention.
Gotcha.
So in the mid 20th century, the typical intervention size is something like 2% of GDP. If you include emergency liquidity, capital injections, debt guarantees, okay, if you focus on these three categories alone, which are the most important interventions, the average intervention is 2% of GDP. Nowadays, post '08, your average intervention is 4x that number.
Oh, Jesus.
I.e.,
That's much bigger.
8% of GDP. So our average budget style emergency response nowadays is 8% of GDP to try and fix something in the banking sector. And that's a disturbing finding that number increases so sharply and so dramatically. It's not just advanced economies, it includes emerging markets. We find the same trend there. It's across the world, whether you are high income or low income, whether you are highly regulated or low regulated. It's true for almost every country in the world. And it does suggest that something is still fundamentally wrong, and continues to deteriorate in a bigger way. And this certainly started before '08. Okay, it's a longer run trend that we are seeing, and maybe ultimately it is a phenomenon that might be connected to the fall in interest rates, because it's a phenomenon of bubbles. Okay, and we know that when interest rates are low, the probability of financial bubbles increases. Okay, so I mean that's a fascinating question for a future paper, of course, but I would venture that there might be an interesting link actually between these two questions that you brought up.
Gotcha. So it's something that maybe interest rate rates, as they trend lower, people try to, invest in riskier assets to get return, and
Exactly.
then something like that.
Exactly. So why do we have the rise of Bitcoin, for instance? Partly, it might be a perfectly rational response to the fact that you earn zero on a 10-year German bond, or a Japanese government bond. So you want to search for alternative investments, for new assets that fill that function that government bonds played in the past. Okay, and I'm not saying that Bitcoin is necessarily a bubble, or that it's not quite rational. I'm just saying, from financial markets, from the banking sector, our intervention metric over time is also a bubble metric over time. Okay,
Makes sense.
it's a proxy for bubble dynamics in the financial sector, and it overlaps pretty nicely with the trends in asset pricing that I talked about for the first half of this podcast. Okay, so
Gotcha.
lower rates, higher bubble frequency.
Makes sense. Makes sense. Very, very interesting. Well, Paul, thank you so much for coming on the show. I learned a ton with you today. I really appreciate it. Where can we send people? Where can people find your work?
You can find me. I'm not super active on Twitter and these social media channels, but I might, maybe I become more active in the future. But you can find links to my webpage there, or if you search for my name, I posted some of my latest research you find on my website, which is publicly accessible if you just search for my name, or if you go on Twitter and follow me there, you can see the link. And otherwise, people will have to wait for the book release with Yale University Press, which will hopefully happen sometime next year, late next year, depending on the supply shortages in paper, I guess.
Right. I love that. I love that.
But yeah, that's the easiest way to look for details and read more.
Excellent. Well, Paul, thank you so much for coming on the show. We'll get those links in the show notes.
No, Will, thanks so much for the invitation, and this was a pleasure to talk to you.
Absolutely. Thanks. Thanks for listening. We'll be back next week with a new episode of Narratives.